With all the debate around negative gearing, I thought it was time in this how-to session to actually look at the numbers, the dollars and cents behind what a decision like changing negative gearing would have on a personal circumstance. So it's important that we take a look at that and unpack that story so we can bring those facts to life. I mean, what upsets me the most about some of the commentary out there around negative gearing is that people are saying, yeah, you run this thing at a loss so you can get a big capital gain, and that's smart investing. That's just crazy stuff. I mean, who would invest $1 so they can recoup 40 or 38 cents back in the losses that they're making? It does not make sense to me. So what I wanted to do was go through this case study. Now you obviously won't be able to see the numbers here, but I'm going to jump into the numbers and step through line by line so you can see the financial impact, and then you can form a view. Because remember, negative gearing is not a strategy. It's just part of the overall decision that an investor or someone going into business will make. At the end of the day, it's been part of our tax system for over 100 years. And it's important to understand that as an investor, I'm investing for the long term. But early on, I might make some losses, no different than when I start a small business. So I want to show you what those financial impacts are. And then when obviously the property turns from negative to neutral to then positively geared. So let's take a look at the numbers and conclude for ourselves. So here we are in our property wealth planning simulator, taking a look at the cash flow impacts of no negative gearing versus the current laws which include negative gearing. So in this modelling assumption, we want to unpack that for everyone. So the salary income is assumed at $120,000 per year, and that's increasing at 3% per annum. Living expenses are assumed at $5,000 per month, again increasing at 3% per annum. The market value of the investment property assumed is $500,000, increasing at 6% per year. Funds borrowed to purchase the property are assumed at 90% loan to value ratio, with an interest rate of 6%. All future surpluses are assumed to be held in an offset account to reduce interest payable on the loan. Gross rental income for the investment property is assumed to be 4% of the value of the property, increasing at 4% each year. Properties are assumed to be occupied and providing rental income 92%, so an occupancy rate of 92%. Effectively, for 4 weeks of the year, it's going to be vacant. Property management fees are assumed at 7.7% of gross rental income, and ongoing costs associated with the property, including rates, insurances, maintenance, are assumed at 1.5% of the initial value, increasing at 3% per year. And no allowances, and this is a really important one, no allowances have been included for potential tax deductions that may be available, because it's a depreciating asset. And this is a really important one for me, because what I want to see in the ATO data that's been provided and scrutinised is how much of that depreciation have they included in terms of the cost or the losses or the so-called tax that the government is missing out on in terms of government revenues. So it's really important to understand that. So let's take a look at how the no negative gearing policy works over time. So let's unpack our columns. Years, we've got 20 years, the property value increasing over time. We've got the rental income coming through. We've got the loan balance decreasing over time, annual expenditure, interest expenses, total costs, and here is the negative cash flow. So this is the negative component of what we're talking about. And you can see here there's no tax benefit. Okay, so this is a tax loss, and that loss is carried forward until the property turns positively geared in just on almost 10 years. And then the property starts delivering us income of which we're paying tax on. So you can see the government does get their tax at the end of the day, and of course if the asset is sold, there's further tax revenues that flow through to the government. With negative gearing, you can see the current situation. So in this particular case, we've got the cash flows coming through, and it's negative for 8 years before the property starts to turn positively geared. Now, again, the lower the borrowings that the investor would take, the shorter the period of time that the property would be negative, and the quicker it will become positively geared and taxes are being paid on that. Now, so it's really important to understand that's the net cash flow position. So that's the tax benefit that the individual taxpayer would be benefiting from the early stages of owning that property. Bearing in mind, they're still operating the property at a loss. Okay, so that's only recuperating a portion of the loss. The property is still running at a loss. So if the property doesn't improve in value over time, it's going to be a pretty poor investment. So obviously you're holding the asset for the long term, where you're seeing the value go up, and you're also seeing that income starting to flow through, which means tax is going to be paid. So tax benefit, and then the tax expense, and then the net cash flows coming through for that client. So it really goes to show that yes, when people are making decisions, it is part of the discussion point in terms of the asset that they buy. But no one goes into a business to run a business at a loss, and property investment's no different. And this potentially illustrates that in terms of the net difference between having no negative gearing and having gearing on the property.
So I hope you took some information from that particular case study. Now, everyone's circumstances are different. Different incomes will have different tax consequences. Different performances in the property will have different results. We understand that. But the most important thing to understand is that negative gearing is part of the overall fabric of the investment environment that we work in. So when we want to go into creating wealth, we should be able to claim any of the costs associated with that. And then ultimately, as we go through that, you saw in the demonstration there that eventually we start paying taxes because we're starting to generate positive income. And property investments for the long term. So there you are. There's our how-to session for today, but it's important to also understand we have other great how-to sessions from beginner right through to advanced. And that's all about building out knowledge and education for you to make informed decisions about your personal circumstances and ultimately creating a better financial future for yourselves. Thanks for watching.